Hi all, good morning. So these are meant to be short boosters. I'm going to make one on each chapter. My plan is they're sort of 5 to 8 minute long sort of things, but they're not meant to be too long. So the idea is you watch this video, you go back again, do the TYUs on the chapter, and this kind of preps you. We go through every chapter and you do all that, and then we're ready for the exam kit. Right, let's go. Chapter 1. What's going on here? So chapter 1 is very much introducing us, if you like, to the accounting equation. Again, this is just short boosters for you to still read the chapter, but then kind of have this to kind of support you. So chapter 1 is fundamentally talking about the accounting equation, telling us how we arrive, if you like, at the very idea of the income statement, if you like, and the balance sheet, or the statement of financial position. So I call it the statement of profit or loss and the statement of financial position. This is where we're trying to go. How do we arrive at the accounting equation? Well, the first thing is we ask the question, or we talk about the principle of business entity. And so we say we have a principle of business entity, and this separates the affairs of the owner from the affairs of the business. So now what fundamentally happens is that the business needs some money to start. And the business needs some money. The business goes to the owner and says, can I have some money? And so the owner says, no problem. So now what we now have is at the same time that we know that the business might have money, so let's say £1,000. So this is an asset to the business. We're saying that at the same time, we can clearly see that the business owes an owner, if you like, £1,000. And so this begins the accounting equation, if you like. The accounting equation is trying its best to make sure that we are aware of the entire picture of the business, not just the good side, what people sort of look at like what's in your bank account. We'd like to know what it is that you owe as well. So fundamentally, the accounting equation begins giving us an understanding of what it is that a business owns and what a business owes. Now, this business might need some more money. So what the business might do is the business might actually borrow some more money from a loan company. So let's say the business borrows another £1,000. So now the business has £2,000 in the bank account, but this is made up of money it owes to the owner and money it owes, if you like, to the, say, a loan company or a liability. So that's how, and we call, and everything else that is borrowed from anyone else apart from the owner, if you like, a liability. So we have the very beginnings of our A is equal to C plus L. That's the key point here. A is equal to C plus L. You can see it. Well, the whole purpose of doing any business is to trade. So we have A is equal to C plus L, and we had here 2,000, and we had here 1,000, and then here we had 1,000. So what do? You take 1,000 of that money, for example, or let's say 500 of that money, and you buy some inventory. And how do you recognize that? With the letter E. So we are ready to sell these goods. We've paid by cash. I could have, if you like, bought these goods on credit. So every single time you can see I'm doing two things. Herein lies the principle of double entry. The fact is that in accounting, two transactions always happen for an event to go through. We never have just the one entry. So now we have us purchasing some goods, then we sell the goods. And then we recognize that sale. So for example, if I sold those goods for £800 and I have the money in the bank, or I might have, if either it comes in as money or I have sold it on credit, so I have a piece of paper telling me, which is an invoice telling me that I'm owed. So we call that a trade receivable. Here this would have been a trade payable. So we have this. We're beginning, if you like, to build our accounting equation. When we talk about profit, we're talking about how much have we made on what we sold. So I will assume that I have sold everything here, this 500. So what do I do to find my profit? I need to take the E over here to this side, and I have I minus E giving me profit. Right? So everything from here on, if you like, is me trying to work out profit, but everything from here on means I start, instead of me always doing this equation this way, we need some, if you like, a language to show the movements, if you like, of what's happening in our equation. So if you like, we fundamentally say that whenever we have movements on this side of the equation, we debit the equation. Or we debit we put it on the debit side, if you like, or we drive on the left. And whenever we have here C plus L plus I, any movement here, we credit it. What does that simply mean? We have a movement here, we say we debit it. when I say good movement, a favorable movement or an upward, when it's not favorable actually, when we have an upward movement, just an increase, any increase of anything on this side, any increase of anything on this side of the equation, we debit it. Any increase of anything on this side, we credit it. So what does that mean? If I was drawing up T accounts, which is what we'll fundamentally arrive at, if we have expenses here, purchases, we would debit it. If we have an asset, we would debit it. Exactly. Here we have, if you like, capital. If it could be capital, it could be liabilities, it could be income. Whenever there's an increase or it goes up, we credit it. And in this relationship, we then have what we arrive at, known as the accounting equation. So that's the first half of this, the first video. Again, I don't want to, I want to keep them at 5 minutes, so they're quite punchy. So what I'll do is I'll make a next video for another 5 minutes on the second half of chapter 1 to end that. Okay, great stuff. Thank you. See you then.